Good afternoon, everyone, and thank you for joining us today for the WAM Leaders FY2025 Full Year Results webinar. My name is Olivia Harris, and I'm joined today by WAM Leaders Lead Portfolio Manager Matthew Haupt and Portfolio Manager John Ayoub. Before we begin, a disclaimer is displayed on the screen for you to read. Everything we just discussed today is general in nature and is not financial advice. To start, I will first give you an update on the WAM Leaders FY2025 full year results. Then I will pass over to Matt and John, who will provide a market update and discuss key investment themes and reporting season insights. We look forward to taking your questions towards the latter part of the webinar. Let's start with the investment portfolio performance. In FY2025, the WAM Leaders investment portfolio was strategically underweight momentum-driven stocks, including some Australian banks, which negatively impacted the investment portfolio performance over the 12 months to 30 June 2025. The WAM Leaders investment portfolio increased 5.9% in the 2025 financial year, underperforming the S&P ASX 200 accumulation index. The investment portfolio performance since inception and the historical profits reserve available have enabled the Board of Directors to increase the fully franked full-year dividend for shareholders to 9.4 cents per share, with the fully franked final dividend being 4.7 cents per share. The fully franked full-year dividend represents a dividend yield of 7.1% and a grossed-up dividend yield of 10.1% when including the value of franking credits, based on yesterday's share price of 1.315 per share. Many of the dynamics which impacted investment portfolio performance during the year are now contributing positively to performance as the momentum trade unwinds. In the financial year to date, the investment portfolio has increased 7.9%, while the S&P ASX 200 index is up 5.5%. I will now hand over to Matthew, who will provide a market and investment portfolio update.
Thanks, Olivia, and thanks for everyone for dialing in today and joining us on the WAM Leaders webinar. Just like to highlight, as Olivia said, it was a tough year last year, but very pleasingly, I can report back that we've had a very strong start to this financial year, and much of those dynamics which caused underperformance have worked in our favour, which we always thought would happen, but it just took longer than we thought. So a very strong start to the year, and we've got, you can see a huge amount of momentum back into the portfolio. So I thought what we could do is just talk around some of the things we're thinking about with markets at the moment and give you a short outlook. In the very short term, when I talk about the next maybe 4 to 6 weeks or 2 months even, it's going to be quite tight on the liquidity front. And what I mean by that is globally, September is a bit of a high issuance month in the rates or bonds. So what happens generally at this point of the year is you get a bit of tightening in liquidity. And if people have been watching this week, you've seen a bit of a sell-off in global bonds, particularly around the longer dated bonds, like the 10 years out to the 30 years. And what this does is put a bit of pressure on risk assets. So you might have seen the equity markets moving down quite aggressively yesterday. That was really in response to some of the liquidity dynamics I was talking about. So when we look at markets at the moment, they do look expensive. There is a lot of interest rate cuts perceived by the central banks coming into the market. We think in the short term, these liquidity constraints and maybe some of the interest rate cuts coming out of the forward market will put a little bit of a pressure on risk assets. And, you know, we've positioned the portfolio to take advantage of this. And we think this dynamic will play out over the next few weeks to 2 months. Post that, November, December, liquidity generally improves in the market as well. So we think it's going to be a very good time to be positioning for that throughout September and October. And what we will see is some of the leading indicators we're looking at the moment, we're seeing a real pickup in activity. It's very early days, but we had a bit of a fall post-Liberation Day and a loss of confidence. What we're seeing now is a general pickup in business activity across the globe as well. And particularly in Australia, Australia's been very resilient. We've almost been an anomaly globally where it's probably the most resilient economy at this point in time. So we think all this should provide a pretty good end to the year in equities. So we're going to position the portfolio throughout September and October in anticipation of improving liquidity into the end of the year. So as we see it, we probably think, it's going to be a pretty turbulent couple of weeks. It might stretch out to October, but it feels like, you've got to be pretty cautious in the next few weeks on these liquidity constraints. But position the portfolio, and that's what we're going to do, position for the October, November, December time when you get an ease up in liquidity. So when we talk about the reporting season, so the reporting season's just happened in Australia, so most of the companies come out with their full year results, some come out with their half year results, and it's a very important time within the equity market to get a read on the underlying economy. What I could say here is the underlying economy is resilient. We think the Reserve Bank of Australia is probably a little bit dovish versus the economic activity at the moment. So we think there will not be as many interest rate cuts within Australia. And again, we've got to position the portfolio in advance of this because at the moment there's very much consensus to be positioned for a lot of interest rate cuts. We think that is probably wrong in the short term. So we think there will be probably one more interest rate cut, and they will be sitting and being very much data dependent post to one more interest rate cut. So for us, it looks like within Australia, resilient economy, maybe one more rate cut. And what we're going to focus on is companies which can cut costs, which can really lean on the cost lever while still having a top line supported by the resilient economy we're seeing. As far as China goes, China obviously huge important trading partner. There's been a huge equity market rally in China. It's probably not followed up by fundamental activity, but we remain quite constructive on minerals and resources. So we think into the end of the year as well, in Q4 there will be a stimulus again in China, more stimulus. So again, we'll be sitting up for that opportunity ahead of time. Also, commodities do pretty well in a lower US dollar environment, which we're seeing at the moment, and also an inflationary environment, which again, we're starting to see the effects of the tariffs kicking in inflation. So the way we see, we're probably a little bit more hawkish on inflation. So we think inflation will be higher than consensus at the moment. The biggest market we've got to look at is the US. We think US inflation could get around 3.5% to 4% by the end of the year. And we think economic activity is a bit more resilient, so probably less interest rate cuts. So we're really positioning the portfolio for that. With that, I might hand over to John, who can talk about some of the portfolio movements as well.
Thanks, Matt, and thanks again for everyone for joining us today. Maybe I'll lift a little bit on the reporting season that just passed. We're quite pleased with the way that the portfolio performed throughout August. As many of you would have noticed, it was one of the more volatile reporting seasons that we've seen in decades, where large caps bore the brunt of many of the larger falls on the ASX. So for us, we navigated and pivoted quite well during this period. And the key stocks that drove the performance last month with names like A2 Milk, Coles, Tabcorp, Pilbara, Mineral Resources, Qantas and Ampol. They all did particularly well throughout August and drove the performance of the portfolio. At the same time, a couple of names we did get hit by, Woolworths not owning Brambles, CSL, although the portfolio was underweight, it was still a big position in the portfolio and had a negative drag on performance last month. And Rio Tinto was just an underperformer relative to BHP. But as we come out the back end of August, we're very pleased with the way that the portfolio is constructed today. We still see a lot of those names that I just mentioned in the top performer category still having a lot of room to run. Others I didn't mention, like NextDC, we think there could be a material re-rating in that name going forward. And then other names that we're starting to revisit where valuation may provide some opportunity. And I've already noticed there's a few questions on CSL. We'll talk about that one in a bit more detail later. Further, some commentary that we learnt during reporting season from the various companies that we saw. Firstly, inflation is ever present, particularly from a wage pressure standpoint, and it's just going to be par for the course going forward, that productivity measures will needed to be taken to offset that inflationary pressure. And one big theme that we're starting to see is lots of job cuts, lots of cost outs, which is the nice way to put it. So AI will benefit and enable all of that cost productivity that companies are thriving to capture. So we're starting to see that. Further, we're starting to see some more green shoots in the domestic economy. The likes of Wesfarmers and Coles started to say that basket size is increasing. People are starting to move off the bottom rung of the value spectrum. So we're starting to see a little bit more confidence from the domestic consumer. Property prices obviously help that. But from that standpoint, it probably puts the market in a fairly robust position. As Matt said, the economy is fairly resilient, which leads to some of our thinking about the rate cutting environment, or lack of, as we should say. That's probably the way to frame August. The team is very buoyant around the way that the portfolio is constructed. It was pleasing to see some of the momentum in the names like CBA and Wesfarmers starting to come out, that heat starting to come out of the market, where a little bit more common sense is starting to prevail around valuation. So from that perspective, we're seeing a lot more opportunities than we have in some time, and we're encouraged about the year ahead.
Yeah, and just if I walk through some of the sector exposures, quite often we like to think of the portfolio, very much from a stock specific level, but from a sector perspective, we're still very underweight the financial sector. We still think bank valuations are excessive, more so CBA. We still think that's really up there on the valuation curve. If we walk through to materials, we have an overweight materials position. The biggest weights here are Rio and BHP. But again, we're starting to introduce, we caught a lot of the lithium rally, which was pleasing, as we saw some chatter out of China around closing some mines or suspending some mines. So we got a lot of the lithium bounce. We still have a decent position in lithium. So we are overweight the materials sector. On healthcare, we are actually equal weight. The biggest weight we have there now is we've been added to CSL a little bit, and ResMed. They really lead the healthcare sector. Consumer discretionary, we are underweight despite the Australian consumer being resilient. When we look at the Australian consumer, quite often we look at the APRA data, which gives you the bank deposits, and bank deposits have actually increased quite a lot. So there is capacity on the Australian consumer to do well. But the reason why we're underweight the sector is really Wesfarmers. It dominates consumer discretionary sector and is almost CBA-like on valuation. It's really extreme. On the REIT front, the REITs, which is the property sector, we have about an equal weight. Industrials, we are underweight because we think a lot of the cyclical names in there, really we can't see a catalyst. I mean, the bigger ones we have in that sector are Qantas, which has done really well. Consumer staples, again, we're around equal weight. The biggest holding there is Coles. We think Coles, as was demonstrated, is really dominating Woolworths. So we have an overweight Coles position, and we really overweight that sector, but then pull back on A2 milk. So we've reduced our A2 milk holding after the incredible re-rate. We still maintain an overweight IT sector. So the IT sector really dominated by a few big names as well. And the ones we are increasing weights in are WiseTech after it got hit during the reporting season after tempering growth expectations. And NextCC was another. Actually, NextCC was a big driver of performance too. They had a really big re-rate off their result. So they're the two big ones in the IT bucket. Common services, again, really dominated by Telstra. We do have a market weight in Telstra, and Spark is another one, which is re-rated from the lows. We've been through a bit of a journey with Spark from the highs to the lows, and it's coming off the lows now from $1.80 to around $2.30. So that's done really well. Energy sector, we think it's quite tough at the moment again. Santos is under a prospective takeover. OPEC have been increasing supply. It's a really bit of a tough market there. So we've been in and out of that sector. And then utilities, our favourite in the utility sector, we have APA, which actually had another great result and has very stable business with a lot more costs out. And then Origin was the other good reporter that was in that sector. But that gives you a bit of a taste of the portfolio. Where to from here? We're probably going to we are taking a little bit more defensive stance. We've increased the cash weighting to around 5% of the fund, and we'll be looking at what sort of levers we can pull through this period, which is going to be testing the equity market. But the real goal is to set the portfolio up for later in this year when seasonally and from a liquidity perspective should be a lot easier for equity. So we're going to try and navigate that. But as John said and Olivia mentioned at the start, really pleasing to see some momentum back in the portfolio. The outperformance is, we've been waiting for it for a long time to come back, but it's really kicked in now. And we think this new market regime really suits us. So, we're very excited about the year ahead. Really happy. And we can open up to questions if there's any questions, Olivia.
Thanks very much, Matt. And thank you to everybody for sending through your questions. Please keep sending them through the webinar platform. We'll first discuss gold, as we have a couple of queries on gold. John, gold prices have reached record highs. Do we have any gold exposure in the portfolio, and what is your outlook?
We do. We do have gold in the portfolio. Basically, gold's a story of two ends when it comes to the Australian market. You've got the really big guys, and then a whole bunch of what we call mid and small caps in the emerging producer space. And for us, the three big guys are Evolution, Northern Star, and Newmont. And the name that we've had for most of this year is Newmont. It sits below that level of the top 20 that you guys as shareholders would get visibility on. For us, Newmont got hit back earlier this year on a poor production report, and that was the opportunity for us to buy a decent holding and decent weighting in it. And since then, it's materially re-rated. Northern Star and Evolution, we've avoided for the most part of this year because of their own production issues, and we feel like they still haven't got a grips of that yet. Northern Star is the one that we do see some valuation support in, but it may take a little bit of time for us to get some comfort around their production issues that they faced repeatedly over the last 2 to 3 years. So then when we peel the onion back and look at the next level down, that's where we've particularly done well. We owned things like Gold Road, and we've owned a number of stocks that have been taken over this year, because one of the themes that we did play, we adopted a barbell strategy where we owned Newmont and a bunch of those mid to small producers from an M&A perspective. And the thematic that's been playing out in the market is size leads to flow leads to share price momentum. And that M&A theme has strengthened in the portfolio. De Grey was another that we participated in when it was taken over from Northern Star. So where we are today, we own Vault, we own Ramelius, we own some Bellevue, all in smaller weights, and Northern Star. So they're the four names that sit. Sorry, and Newmont. They're the five names that sit within the portfolio. From a gold macro perspective, we think it's extended right now. That's not to say we might not see another 4 or 5% rally, but I think directionally over the next 12 to 24 months, it's probably going to be heading south. But Matt can provide a little bit more context there.
Yeah, just a little bit more context. The portfolio has 1.5% weighting in gold at the moment. We did flex that up to around 3.5%. But as John said, we feel like there's probably on its last legs for the rally. And if gold was to shoot up from here, there would be some sort of existential crisis. So, it's really been benefiting from US dollar weakness, inflation ticking back up. There's quite a few technical reasons why gold's going up as well. We have a 1.5% in the portfolio. Unlikely to go higher from here unless we can see a real catalyst, which would give us reason to increase our gold exposure. Potentially, I could see it going down, but again, we like to run, even at its minimum around 0.5% of the portfolio in gold, just because it's a nice little hedge against market disruption. So we are underweight gold. In hindsight, probably should have been a little bit more overweight for longer, but again, we've captured it through other means, but not directly through gold.
Thanks, Matt and John. The next question is from Ian and Robert. Matt, can you talk a little bit more about the reasoning for the underperformance during the last financial year?
Sure. I put it down to there's probably two reasons why. One was the excessive valuations or being underweight financials and some of the big momentum names like Wesfarmers. That explained around 55-60% of the underperformance by not participating in what we thought was excessive valuations. The remainder was really legacy issues from stocks we own from a while ago that effectively almost went down to zero. So that was a big drag, and that was still a feature in really the first half of FY2025. So, but then actually carried on into the back half as well. So that was the remainder of it. So legacy holding, also Spark had a big derating as well, which was around 1% of the underperformance. So the majority was just not participating in what we thought was excessive valuations, but there was some bad stock calls. In hindsight, they were bad stock calls. But again, we've refreshed the portfolio. We've got new positions in place. All the legacy issues are gone. So that's what you're starting to see now, the real performance, which shareholders are used to and what we're used to, because we hate underperformance and we fight as hard as we can to get it back. So that's what we're doing at the moment, and pleasingly we've had a really, really strong start to the year, and hoping to continue that momentum for the remainder of the year as well.
Yeah, just for some perspective, we've already clawed back around a third of that underperformance already this financial year. So it's not enough. We want to claw it all back, and that's what we're aiming to do.
It's actually around 40-odd%. Yeah, it's pretty close, yeah.
Thanks very much, guys, for that clarity. And just following on from that, a question from Campbell. At what price would you consider getting equal weight into CBA?
I mean, that's the greatest question ever. Like, no one unfortunately knows because it's not really dictated by fundamentals. So, fundamentally, it's worth about $80, $90. It's trading at, where it's
169,
high 160s. So it's still fundamentally not correctly priced, but it's really an expression of it's quite a complex explanation of what's going on. But effectively, there's too much leverage in the world, and it pops up in all these weird places. And CBA has been one of them. So when you see unwinds in this levered global trade, you see CBA share price exaggerated like movements. So when we saw the yen carry trade fracture in August of last year, CBA was down 7% in a day. Like it's extraordinary because you have this excess leverage positioned in these names. Then on Liberation Day, you saw the same thing. As soon as you shock the system, you get oversized moves. And what we're seeing now is a little bit of a liquidity event where there's some liquidity drain in the market. Even yesterday, it was almost 3.5%. It was almost down 4% on a global bond sell-off. So you can see this is artificial. It's linked to factors which are not fundamental. So when you ask what price do we have a grow at CBA, you can either play the liquidity game or the fundamental game. We like to say we could play both. We have flirted around with CBA a couple of times, whether we put a little bit of money to work in it and then pulled it out, because unfortunately the gap between where the share price is and the fundamental value is too large for us. So at this juncture, to go equal weight, I don't think it will ever happen at this price, barring a reason why this liquidity trade would continue. So let's say, this liquidity trade all started when the SVB bank bailout in the US. So what happened there was a regional banking crisis in the US. The Fed stepped in and said to all the banks, hand whatever collateral you want and we'll give you full face value for it. So effectively, there was zero risk on all these securities in the market. That was the cause of a fundamental re-rate and the leverage going up in the system, because everyone thought there's going to be bailouts no matter what happens. So the rules of risk were rewritten. And it reminds me of LTCM blow up, which happened in 1998 from memory, where it was a relative value big macro hedge fund, blew up, was bailed out by the banks, everyone went max long because they thought there's no risk here. We'll always get bailed out. What you saw that was post that was the .com boom. So it's sort of rhymes with that period where the Fed bailed out the banking system and everyone went max long risk. And risk is mispriced still. Credit spreads are incredibly tight. It is so, some assets are incredibly mispriced, and that's what we're seeing at the moment. So to answer the question, you really got to make a call on the liquidity game, the leverage game, whether you want to play that or not, when you think it will break, and if you think it will continue, because fundamentals, it just doesn't stack up here. So, I mean, that's a long-winded answer, but it's the only way to look at it at the moment.
To support Matt's view, we are currently in the DRP pricing period or DRP purchase period for CBA. Historically, CBA would go up every day during this because they're buying 10 to 15% of the volume. It's been going down. So that's one thing that's an abnormality. For those on the call, many of you have followed CBA for decades. A 30 or 40 or 50 basis point move in the share price was a big move. Seeing 3.5% and 6% and 7% moves in CBA is not normal. On the result day for a rather inline result, it moved down 6% and since then it's retraced. So we're not talking fundamentals, we're just talking flow. And the way that one thing I can guarantee you is that we won't pick the bottom in CBA. But what we can do is try to average down if it starts to fall and try to protect the portfolio that way.
Thanks very much, guys. And we've got quite a few questions on CSL, which you did touch on briefly. From George, Henry, Ashok, and Leon. Is the plunge in the CSL share price a cause for concern? And what is your outlook in the medium term for this holding?
The big change that took place in August for CSL, and I think many of the people that would have been on the call back in March when we last spoke to shareholders on a webinar, in the February result, what drove a strong CSL result was the historic Behring business, which is what we all know is the blood business. That drove strength in the result and provided some comfort for investors that the main engine is humming. And there were some weaknesses in Seqirus and V4. Fast forward to August, the complete opposite happened, and that spooked the market, rightly so. The pivot or the U-turn in the Behring business is cause for alarm, and the share price reaction on the day was probably warranted. I guess from here, what we need to see is that stability return from the Behring business. We need to ensure that the long-term growth story that we have known and have loved is still intact. Now, they're doing an investor day in November, and hopefully they provide a little bit more of a framework and reassurance to the investment universe around the long-term projections of that business. And Anna from our team will be heading over to that in November. The second signal that spooked the market again was the flagging of the divestment or the spin out of Seqirus. Again, people's concern around that were, what does the future look for that business? Are they just handing off this effectively orphan business that has no growth prospects to shareholders to deal with because the management didn't want to? We probably don't subscribe to that. We think it's probably a better business as a standalone with its own management and focus. So we probably think that's overblown in the market, but really our focus and for us to go overweight in a meaningful way, CSL going forward, is to get some reassurance about that Behring business.
Yeah, what we saw was a PED rate. So in the way we look at companies is on a PE ratio, which is the price to earnings ratio. And CSL traditionally is traded on a high PE ratio. We saw a huge PED rating because of question marks around Behring. So earnings weren't that bad from a group perspective, but it was just a PED rate. Like most people have followed this since the float, back in the 90s, and you could always bank on double-digit growth. And now there's question marks. So we saw a D rate of the price people are willing to pay for it because there's question marks. So it's probably back towards an interesting level now, a market multiple. it's probably better than a market multiple, but again, like with managing money, you have to deal with sentiment as well, and the sentiment is bad. So, it's on our radar whether we need to go high in CSL. We're still waiting for this sentiment angle to change because it's very much spooked a lot of the market. But the business isn't broken. The growth rates, people are talking about competition, and we don't think the business is broken. We think it will return to decent growth in Behring. So there will be an entry point. We talked about $180. As for us is, barring nothing changing, would be a very attractive entry point. But anything sub 200 probably at this point in time looks okay. So that's sort of how we're viewing CSL.
Well, maybe some context around the market that we're operating in, and I think we've flagged and spoken about it before around the dominance and the emergence of quant and index funds. And one of the big things that they look for and they screen for is momentum and earnings revisions. CSL is at the wrong end of that spectrum right now. You've had earnings momentum turn negative and share price momentum turn negative. And what these guys look for is a stock going to beat market expectations? Yes. Can we hold it safely for the next 6 months? Yes. In simple terms, they buy it. CSL is probably 3 to 6 months away before they can provide enough comfort for these price agnostic investors to really get involved again. So on the questions around, are we overweight? Will we go overweight? Right now, we're slightly still underweight. We need some real valuation support, to Matt's comments, to go overweight, so as we can fight that tide of momentum. And as we've seen from stocks like A2, when momentum turns, it turns pretty savage, and these share price reactions go hard quickly north. So it's just something to bear in mind when investing currently in this world.
Thanks very much for that, guys. And another stock question: what are your views on ResMed?
ResMed we really like. It reported really well. Great top line, great margin. Really like the business. There was the big chat around GLP-1. Will it hurt the business? Actually, it hasn't affected it. The business has great momentum. It's actually drifted a little bit post-result. And we've been adding to ResMed. In the low 40s, high 30s, we thought it looks pretty attractive. Is drifting back towards there. I think it traded up to around $44 around result, and then it's just drifted, which often it does. So generally, a good strategy is selling a little bit of ResMed on a result day, or a day or two post, and then buying back in, and we're doing that at the moment. Yeah. So for us, it looks solid. Can't see too many issues with it. There is talk, Philips will come back in a meaningful manner. It's just tough, and we think ResMed have entrenched themselves throughout the network as well with the businesses they have bought. So they are almost a bit of a IT player as well as having the mask and the hardware. So it looks really good.
Yeah, it's a very noisy stock, we'd say, ResMed, because it always delivers at results, and in between results, people start jumping at shadows and start to make noise. And I think one of the things that Matt's point is that you need to be a little bit more nimble, and towards reporting periods, that I think it's certainly going to be a material overlay for us.
Thanks, guys. And we have quite a few questions on Coles and Woolworths from Mark, Henry, Bill, George, Scott, and a few others. Could you discuss your thoughts on the significant moves within the top 50 during reporting season, particularly Woolworths and Coles, and how you're positioned with those two companies?
It's a great question, that one. And Matt saw Coles earlier in the week, and I saw Woolies yesterday. And I think the comment earlier around momentum, and momentum is a very important factor when it comes to retailing. And Coles has all the momentum right now. They're executing brilliantly. They've simplified that business. Leah's done a tremendous job, really focusing that business on what the consumer wants. So from here, we continue to see only strength for Coles over the next 12 months. And at the result and post the result, we've increased our weight, and it's around about 2.5% of the portfolio. Historically, Woolies has always been the stock that's on the higher multiple, on the higher valuation. Woolies has a bit more challenges ahead of them. They do have the better network, but they've got more balls in the air that they need to juggle right now. Coles is a very simple story. Woolies is a little bit more complex. Management needs to turn the ship around, and with all big ships, it takes longer than people think to turn that around. So going into the result, it was unfortunately an overweight. On the result day, we did significantly reduce our position to the state where it's minuscule right now within the portfolio. Does that say that we think Woolies is broken for the long term? No. We'd love an opportunity to get back in there because we do believe that management will turn this ship around. But the question is how long it takes, and we can't see it happening in the next 6 months.
Yeah, and as John mentioned, I had the better meeting this time. I had Coles, and it was smiles all around with Coles. Great momentum. I'd say the big difference is availability. Coles have actually nailed this, whereas Woolworths had a few issues again with availability, like on shelf. Also theft. Coles boosted their efforts against theft, and the criminals have found the easier option now being Woolworths, so they've moved over to Woolworths. So now Woolworths have to address theft with gates on exits and the like. So Coles got the momentum. They've got their distribution network working now after a huge investment. So clear momentum. And it reminded me back when John and I was buying Woolworths, I think it was like $16, $17, $18 when Brad Banducci first came in. And it took about 3 or 4 years to get momentum. So like John said, it takes a long time because people get into a purchasing pattern and they don't move unless it's a compelling reason. So even if the competitor's doing a great job, they won't even know because they don't move. So it does take a long, long time to turn these things around. So at the moment, Coles have got the momentum. We're back in Coles. It's at $24. It can go to $25, $26. And starts to look expensive. Whereas Woolworths, I mean, if it got down to $24, $25, we'd have to seriously have a look at it. I think it's trading around 27 at the moment. So a little bit off. Again, you don't want to go, as John pointed out, in this market, you don't want to go too early because there is no appetite for getting in too early because people want to see results. They will not invest ahead of time. They'll rather wait for things to turn and miss out a little bit of the early turnaround sign. You got to be very aware of that, and that's something we learned over the past 12, 18 months as well. Is you will not get rewarded by going in too early.
One thing what's worth highlighting is there's a lot of speculation in the media around pending price walls in the retail sphere. One thing we've got comfort is that there won't be price wars, but there will be changing price strategies. At the moment, Woolies relies heavily on effectively a high-low strategy. I think we'll start to see a little bit more consistent everyday low prices. I think we'll start to see that come from them to try to eke back some of that market share they are losing. And they're not only losing market share to Coles, they're also losing market share to Aldi. They're losing market share to Metcash and to some of the fresh grocers like Harris Farm. So, look, it's going to be a battle, but, I think we just got to get the timing right.
Thanks, guys. And we have a couple questions on China. So Matt, I'll go to you for this one. George has asked if there are any themes coming out of China that would impact your investment strategy. And George has asked if you could in particular talk about BHP, Rio Tinto, and Fortescue, if there's a better positioning there.
Sure. Thematics-wise, it's a little bit quiet up from a stimulus point of view because when we look at China, because GDP has been quite strong, there is no incentive to stimulate. And also, while there is tariff issues, there's no reason to stimulate as well because they don't know the tariff outcome with the US. So it's been very much status quo with China with no big themes. The one thing I'd point to is the rationalisation of industries. So you might have seen lithium was a sector which we mentioned earlier where the government came out and cracked down on some of those mines being used and trying to rein in speculative is probably not in the right word, but just pulling back some of the supply. And that looks like it's happening across a few industries. So that's interesting at the margins. Lithium was very interesting because the lithium sector was so shorted. So everyone was positioned very negatively for lithium. So the moves you saw there were exaggerated because of the positioning going into it. The other metals don't have those dynamics, so there's not really a play yet. What I'd point to, though, is that there's some quite important meetings coming up in China, and we think Q4, so the last quarter of this year, will be a very important catalyst for the government. They need to hit their GDP numbers. They will have to do some short-term stimulus, but also set up the run rate for next year as well. So we think from a thematic point of view, you probably don't want to go too overweight materials at this juncture, but later in the year, it could set up for a very nice trade. So, and when we talk about preference, I mean, for us, it's BHP and Rio. I mean, they're our two stocks that we like. Both we like, depending on price. I mean, that's really dictates where we put capital to work. But we're more overweight Rio Tinto than we are BHP at this point in time. Rio Tinto is probably, well, it does have the better growth profile over the next decade. There is lithium's been a bit of a question mark, but it's really quite a rounding error for Rio Tinto. But BHP have actually been doing very well in production as well, so they actually are performing well. So we don't have a huge preference between the two, but it often will be dictated by relative price movements. And then Fortescue, we did buy that. It was in the low 14s, 15s. So re-rated to 18s now, and we've reduced that. Fortescue is like a fair weather stock where if the sector was ripping, you'd go Fortescue over the other two if you want real bang for buck, but it's riskier. So generally what we do, if we get into a full-blown rally in the iron ore names, we can wind Fortescue up to 2.5% of the portfolio, but that's generally what we do, where we would run Rio and BHP around 7% of the portfolio. We could go up to 8 each if we had real confidence around that trade. So from a risk perspective, we run Rio and BHP at higher weights, but Fortescue can go up to around 2.5% of the portfolio. But again, we might look at it around October, November to go increase Fortescue, but at this point in time, we just can't see a reason to deploy more money into Fortescue.
Just two comments, Dad, on that. Around the cost curve support for iron ore, it feels like $90 to $95 is where iron ore bottoms out, and a lot of that marginal supply comes out of the system. So from that perspective, if you're in an environment where $100 iron ore is prevailing for the next 6 to 12 months, we envisage both Rio Tinto and BHP to talk about large buybacks. And that probably is the marked difference between BHP and Rio versus Fortescue. Fortescue are going in a capital investment phase. They won't have the ability to do the buybacks, whilst Rio Tinto and BHP, we envisage significant buybacks this time next year if the iron ore strength remains.
Yeah, I'll be going up to China in October. So next webinar, we'll have a lot of on-the-ground information we can share with you around China as well.
Maybe we can do it live from China.
I don't think we can stream out of China.
Thanks, guys. And Matt, we have a couple questions on liquidity easing. You mentioned positioning the fund for an easing in liquidity later in the year. Can you talk about how you might plan to do that? And a follow-up question to that is how you think it might affect bank earnings.
Sure. Like when I mention liquidity, it's really financial liquidity. So it's when we look at the plumbing in the system, effectively we look at leverage and how easy financial conditions are, which really dictate how asset prices move. So when I talk about liquidity, it's nothing to do with the stock or the ASX, really the ASX. It's the global system or the plumbing, how easy and how easy is it to get money and how cheap is it to get money, and can you lever it up? So what I talked about is September is normally a tightening of liquidity. So that's generally bad for risk assets. And it's generally a seasonal thing because there's a lot of issuance. So when governments or corporates need to raise money, they come to the market and ask for for money for issuing paper like bonds and draw out of a lot of liquidity. There's also a movement in the US. It's quite technical, but the TGA account, which is the account the Treasury have, it runs down with when the government pays out money or they collect, and it goes up when the taxes come in. But effectively, they have to rebuild the TGA account up, which is going to withdraw around $300 billion of liquidity. So generally, that environment is not good for risk assets. So the way we position for that is reduce some of the risk within the portfolio. So those expensive stocks like CBA, if this does continue, will get hurt. Wesfarmers, but overall the whole market gets hit, and we saw that when the bond markets globally started to sell off a bit on Monday, Tuesday, Wednesday. The ASX was down 1.7% on the, was it Tuesday? Yeah. It actually Wednesday. It actually hit quite hard, and you can see how markets are linked, and markets are effectively run by this leverage in the system. So when you strain that, things get hit. So we could see this happening Monday, where the Australian rate environment, we saw the 10-year government bonds starting to sell off, and then the UK started selling off, France started selling off, and then the US started selling off. So there's a global thing happening, and that really hit the Australian share market. So when we talk about liquidity, it's really that global liquidity piece we're talking about. And how do you position for that? When it becomes tighter, you reduce risk. When it becomes easier, you add risk. So when we talk about liquidity will get easier later in the year, we will be adding to some of those positions which potentially will get hit. Maybe not CBA, but then things like on the IT sector, like the growth sector, which might get hit from higher long-end rates, you might add to the growth sector. We'll actually deploy some of that cash. So, we look at markets through macro factors, fundamental factors, and positioning and liquidity. And, when liquidity is getting tighter, it's bad for assets. When it's getting easier, it's good for assets. So that's sort of how we view the world.
Thanks very much, guys. And we have a couple questions on Aurora and Amcor from Simon and Ian. Can you please comment on your overweight position in Aurora, as noted in the end of August update? And can you discuss your thoughts on Amcor?
I'll tackle both of those. It's pretty simple, the discussion between those two. We feel like Aurora's bottom now. It was a decent position last year. We traded it pretty well, selling most of our position at 250. We bought a lot back in the low $2. Where we think there's strong momentum in the business is the canning business, where cans of Coke no sugar and stuff like that, where that demand continues to be very resilient, and they are best in class when it comes to that. The more questionable side of the business, Saverglass, which is the glass bottling business which they acquired, we feel like that. When you look at some of the global players there, being Pernod Ricard or Remy or whoever it might be, we feel like that sector has bottomed. A lot of the capacity has come out of the market. So from that perspective, at about a 8 to 10% free cash flow yield on a very undemanding multiple with a really strong balance sheet, we think it's a good resilient position to have in the portfolio. It's probably a very likely potential takeover target if I was being frank. So we're really happy to own that one, and we think it's going to be a fairly good 12 to 18 months for that one. On Amcor, the challenge with that one is the end markets. That is a business that operates on very fine margin, and its end market clients like Kellogg's or Procter & Gamble or whoever it might be, we continue to see a decline in volumes in the market, and particularly in their rigid plastic business, which is Gatorade bottles, effectively. Demand for that segment is weak. So for us, we need to see a bit more stability in the end markets of Amcor's customer base. And when we do see that, and it comes back to timing and getting the momentum and not going in too early, when we do see that stability, we do believe that the synergies they got from the Berry transaction will drive this to a re-rating. So for us, we can see a path for Aurora right now. and the path for Amcor is probably a little further down the track, maybe back end of this year.
The only thing I'll add to there is Aurora. Like I caught up with the management, and it's really a cash cow for to 2031. They effectively have done all the capex they need to do, and are generating a huge amount of free cash. So puts them in quite a vulnerable situation, I'd say. A great industrial company with spitting out cash. High single-digit free cash flow. It gives them a lot of flexibility on balance sheet. So that looks very attractive to us. Yep.
Thanks, guys. And a couple more stock picks. What are your thoughts on APA Group? That's from Colin.
Yeah, APA has been a great investment for us. We have been invested for about 2 years in that company. The real kicker here was the cost out opportunity. I'm not sure if I can share this around there with their employee costs, but yeah, they had a really inflated employee cost, which they were getting a handle on for a couple of years around how many people were employed and where they were employed and how much they were paid. And, they did a real big exercise on this and have really taken out a lot of costs. So cost has been a big one. And the biggest one has been the regulatory framework. There was a risk for this business to be regulated out from a price perspective, but that's all sorted now. So APA looks very clean, very lean, very predictable, high free cash flow, can fund all their growth aspirations through their own free cash. It looks very solid to us. I mean, it's not a exciting business where you get super excited about what they do, but it's a boring business, which is good sometimes. It generates a huge amount of cash, very predictable, and it's a great addition to a portfolio to have there as a base that's going to be very dependable. So APA, we still like it. We still think it's undervalued. It could easily trade back to $10. But no, we thought that's 2 results in a row. They've done really well. So they do have momentum and credibility. And we think it's a very attractive asset.
Thanks, Matt. And what are your thoughts on the recent fall in Reece? And do we have a position in that company?
We don't have a position in Reece. I would implore anyone who can get access to the most recent Reece conference call, shareholder call, because we do get very limited access to Reece management because it's effectively run like a private company. But if anyone can get their hands on that conference call transcript, it makes for great bedtime reading. It was one of the most refreshingly depressing conference calls that we've listened to in a long time. They told us how it is, not how it could be. They told us how tough their end markets are, how challenged the US rollout is, how much competition they're facing in Australia, to the point where it really challenges anyone who is buying that stock today. You really need to take a very, very long-term view that this business will turn around. And fortunately, we learned the lessons of James Hardie's, and we were underweight. James Hardie's went at the result time, and we'll come to that later. But we didn't hold a position in Reece, although admittedly I was the one in the team pushing to have a look at it because it's come down a long way. But the end markets it's operating, the competitive dynamic, it's very, very challenged. I even raised it again with the team, and I was shot down fairly quickly yesterday. So we are keeping an eye on it. It still screens expensive from a valuation perspective, and markets are certainly not getting easier. So, we think there's probably another 6 to 12 months of tough times in there. The one comment I will say, I wouldn't be surprised to see if this company wasn't listed at some stage, because it's run privately to the credit of the family.
Thanks very much, guys. And the next question, there was one on Santos. Yep. From Sam. What is your view on Santos and the possible takeover, taking control offshore?
This is, it's going to get noisy. It's going to get political. I think we had previously expressed that we shifted our preference to Woodside, and even with a takeover, Woodside has outperformed Santos of late. What we do think happens is that the deal does go binding. ADNOC aren't there as tire kickers; they're genuine buyers. The question is, what shape does this eventuate in, and how does a transaction take place? Federal politics will certainly get involved in this. I wouldn't be surprised to see if there's a breakup of assets. Potentially, a lot of the domestic gas assets either end up in different structures with certain guarantees or agreements with the government to ensure that domestic supply is locked up and granted. So, from our perspective, we think that the deal does eventuate, but there are certain conditions and obligations that will need to be fulfilled, and certain promises that will need to be made to ensure that the political aspect of this deal are appropriately compensated.
Thanks, John. And the next question is on Wesfarmers. What fair value would you attribute to Wesfarmers, and why? Larry says, in the introduction, you compared Wesfarmers as overvalued to that of CBA. In your response to equal weight for CBA, you listed a number of macro impacts.
So I think the Barrenjoey research analyst had a title for his note, 40 times for 4% EPS growth. That's not something we're particularly fond of paying. Wesfarmers undoubtedly has the best business in Australia, which is Bunnings. I think we've acknowledged that several times on these calls. Trading in Bunnings is circa 4%. It's facing inflationary pressure. It is having to move into new markets to capture more growth. They are executing phenomenally, and they are a wonderful value proposition for the Australian consumer and will be ever present in this market. Kmart is another wonderful value proposition for customers, but that's starting to slow down. And WesSF and the lithium businesses are not 40-time multiple businesses. So for us, they are executing in the same way that CBA is executing, but the valuation for us just doesn't stack up. And I think if there was some dislocation, and if it got back to, maybe high 20s, low 30-time multiple, which I don't think we'll see anytime soon, that's probably where we consider going overweight.
Yeah, which is around mid-40s.
Maybe 50s.
Yeah, which is a fundamental value, so trading around $90.
Thanks, guys. And the next question is from David on WiseTech. Can you talk about your views on WiseTech there, and if you're comfortable with the governance deficiencies in the company?
Yeah, I mean, two questions there. Do we like WiseTech? Yes, amazing business. There was a hiccup around their perceived growth rate slung in their core business, cargo-wise. After chatting with the company and doing our research, we're not overly concerned with that short-term pullback. It's really just delay. But the business is in the best shape it's ever been. As far as new contracts coming online, the acquisition we think will surprise to the upside. So, yeah, we really like WiseTech. It's expensive, yes, but the business is going really well. On the governance issues, it's a tough one because Richard White, obviously, from a media perspective and personal perspective, there's a few question marks, but from a business perspective, he's unbelievably good. And he's a key person within the WiseTech business because he lives and breathes the business. So for us, it's a bit of a conflict. We generally like to stay out of those arguments, so we just focus on the business. So, Richard's very much engaged with the business again. And from our perspective, it's looks like a great opportunity over the medium to long term. And we have bought some WiseTech. We did have some into the result, but have actually increased the weight post-result. So we think there's a great opportunity here.
Thanks, guys. And we have a question from Richard and Debbie. What are your REIT picks, and what are your thoughts on DGT?
Okay. GPT and Goodman Group would probably be our two standouts in the REIT space. Goodman, the market for some reason is fixated on they doing a massive deal on all their data center rollout. We expect to see a number of deals, not just one, a number of deals over the next 12 months, which will highlight the strength and the robust growth profile that they have. So Goodman is a standout. And GPT, it's moved from a stock which should trade at its NTA value to a growth story, and it's doing significantly well right now. So they're probably the two REITs. DGT goes hand in hand with Homeco. They're not stocks for us. There's a cohort of stocks that trade cheap and will always trade cheap because of perception issues, and those two have some perception issues right now. So we think there's a lot for those companies to do, a lot of water for those guys to tread to get to our investment universe. So we'll leave those two alone for a while.
Thanks, guys. And given that we have a lot of stock picks coming through, we might do some rapid fire stock selections from you. Maybe you just want to say buy, hold, sell, or if you want to add some more commentary, you can, but I'll just go through them. Sigma Healthcare.
It's a hold. A lot of selling pressure will be washed through the market over the next 6 to 12 months as those insiders take their profits. Wonderful growth story. If it settles in the high twos, or we'll probably look to buy it later this year.
Sonic Healthcare.
Probably a hold. Like in the low 20s it's a buy, and high 20s, early 30s it's a sell. We don't fall in love with stocks. Valuation rise. So I think it's trading 27s around that. Yeah. So it's sort of in no man's land at the moment. But we do own a small position. We picked it up when the market sold it off on its results day. So a bit of a trading opportunity there.
Next is Zip.
Buy. A heap of momentum in this thing, and it should continue to grind higher.
James Hardie.
Well, that's probably the toughest one out there at the moment. Like, market hates it. It was a shock of a result. A few question marks around management. People haven't really trusted, what they said and what they delivered. So huge question marks out on this one. But again, if there is a turn in the cycle over there, which there isn't at this point in time, we will look at it again. So at the moment, it's not even a sell. Like we own a tiny bit to have a look at it. So it's just a hold.
A buy on a 3-year view. In between, we don't know.
Yeah.
Thanks for that. Tabcorp.
Gil McLaughlin, the CEO, has done a wonderful job in transforming this. We've done very well out of it. At $1, it's gone up 50% very quickly. We still think there's more. It does need to consolidate at these levels for a little while, but there's a lot more to be done for this stock, and we can easily see it, $1.50 in 12 to 18 months' time.
Thanks for that. ANZ. Sorry.
ANZ, for us, it's this. Again, all these are very complicated because they're not just straight buy, hold, sells. For us, Nuno is doing the right things at this point in time. It's cheap. They do have AusTrack ASIC fines pending, I'd say. We'd like to see the size and quantum of those fines, and then you'd probably buy it on the ASIC AusTrack fines.
Next one is Guzman and Gomez.
Yeah, this is a tough one. Valuation is still up there. High quality business, great rollout story. Some hiccups. The last two results, markets expected and wanted more. The most recent result, the trading update was significantly below where market expectations were hoping for it to be to support the valuation. The next 6 months are critical for this stock. If they can demonstrate that it was just a hiccup and not a step change, then it will go back up. But the next 3 to 6 months trading are really important. So I'm going to sit on the fence and put on a hold.
Thanks, guys. Next is Domino's.
Oh, this is a really tough one. It's cheap. It's cheap as it's ever been. It feels like they're building a strategy on the run. They're adapting to the market conditions as they can. They're talking about restructuring their pricing dynamic. And when we hear that kind of stuff, it always takes longer than you anticipate. So we're happy to sit on the sidelines for a while.
Yeah, I'd almost say as well, there's a bit of a health element here too. We've noticed alcohol sales have fallen off, and high-calorie pizza has taken a bit of a hit as well. As there's a real change in preferences. So again, you got some big headwinds in the industry at the moment as well. So tough spot. But again, we're attracted by the valuation, but it's too hard for us.
Thanks, guys. Next is Harvey Norman.
We own a little bit of Harvey Norman, and they're taking share. They're doing really well, and particularly the electronics department, in a replacement cycle for computers and hardware. So they're taking share. They've got some momentum. We'll hold our position. Consumers getting a little bit more resilient. So yeah, probably a buy still.
Thanks, guys. And do we have a position in Block?
Yeah, we've got a small position in Block actually. It's been up and down a lot. It's promised a lot. There's a huge cost out potential. It's a small position. It's 25 basis points, or around 25 basis points, or 0.25 or 1%. So very small. We got in there around $80, $90. It has re-rated a bit. Going forward, like John mentioned, the momentum's in Zip. They've really been kicking some goals, whereas Block's a little bit harder at this point. So we much prefer Zip.
Thanks, guys. The next one is SX2 for gold.
We will have to take that on notice. It's probably a bit of weekend research for me. We'll take it on notice, and if it's interesting, we'll get back to you.
And 4DX.
I think that's another one for the small cap.
Yeah,
okay. Yeah. Thanks, guys. And the next one is Woodside.
Yeah, so Woodside will become, it's a tangled mess when it comes to Santos. If Santos comes off the bourse, and you look at 70-odd% of the large cap investors in Australia, they've had a strong preference for Santos. So I'd expect that if Santos were to be taken over successfully by ADNOC, we would expect a lot of money to flow to Woodside. They're executing particularly well in some of their assets like Sangomar. We expect Trion and Scarborough the ramp ups there to be really positive. So we're a buyer of Woodside, but there is a big caveat around what the hell OPEC do.
Thanks, guys. Next is Treasury Wine Estates.
Yeah, this is we
picking all the battle stocks at the moment.
This is the battleground.
Everyone's going for the cheap broken, well, not broken business, but severely under pressure. But I mean, TWE is another one. It's in the Domino's camp. It's the GYG. It's the alcohol segment's been terrible, and it doesn't look like it's getting any better. So it's under a multi-year D-rate, I'd say, from a growth perspective. So yeah, a long battle. We look at an NTA sometimes, which is around current price. So from that point, it looks attractive. Could they get NTA potentially? So yeah, around NTA, we think there's a bit of a flaw, but again, we're not confident. Again, I think the common theme here is we've said don't be too early, and I think that still holds. You won't get rewarded going early.
It's probably worth this one. We did previously have a rather sizable position in Treasury. It's probably worth giving a little bit more context. And we exited most of that position at around about $11. But the biggest challenge here is that US business. And the US business could be characterized by two traits. They've got a very high-end portfolio that's doing well, and a low-end portfolio which is really, really struggling. It's falling at 15 and 20%. Volumes are declining by. So they have a distinct challenge in the US about trying to shore up that lower end wine category they have. They're changing distributors, which probably leads to another downgrade. And then some policies in China are starting to lead to lower consumption of some of the great Penfolds wine that they distribute up there. So, there is a lot of noise, and in the absence of that noise, I think this is a transition year, especially with Tim Ford retiring and the new CEO taking the reins in November. So, it's probably something we're going to look a bit more in earnest next year.
Thanks, guys. I might move to some more macro questions and then come back to a couple of stocks. One of the questions was from George. Do you automatically exit a stock if it drops out of the ASX 200, or do you have flexibility around that?
We have flexibility. Our decision to sell if something goes in and out of the 200 depends on what we think the longer term prospects of it. So, we don't instantly sell. We have flexibility.
Thank you. And the next one is from Ian. How are you playing AI implementation?
I mean, for us, AI, there's various ways you can play it. Australia's not a pure play in the traditional sense. But the way we play it, there's the first bucket I'd characterise as cost out opportunities. So AI replacing, some of the low end tasks within call centres and handling call volumes. And the big beneficiaries here, I'll point out, is Telstra. That's a really big beneficiary. Also, the Australian banks. Anyone with a really high employment cost or really labour-intensive call centres, or they are the real beneficiaries in the cost side. Productivity is a little bit tougher, but you could argue that's a little bit of a benefit on productivity too. But that's a little bit more unproven yet. Obviously, there's the data center side where there's going to be this incredible increase in data intensity, which again Telstra actually benefits from the transfer of that data. But companies like NextCC and Goodman Group. So there's very much capital is still flowing into this space. It is a growth sector, so we can play it through that way. And then the final way we can play it is through energy demand. So energy companies such as Origin or AGL, or probably not AGL at this point in time. Our preference is Origin, and APA as well with distribution of energy. So there's various ways you can play it, and we definitely pay attention to it. But probably say the biggest impact for us has been deploying capital into data centers and into the cost out opportunities. Energy has been the tough one because energy is dominated by external factors as well. But obviously in the US, there's a lot more ways to play it directly, but other ways we play it.
Thanks, Matt. And that flows in nicely to our next question from Chris. As our energy security and affordability is being destroyed at an alarming rate, how do you position the portfolio in light of this?
I mean, that was probably the highlight from the reporting season, the political statements from a couple of the CEOs. So, I mean, the ones I was just scribbling down here was BlueScope, if you listen to that conference call, APA as well, talking about how ludicrous the energy policy is, and mainly around gas, and saying, I mean, to summarise, there's not a supply issue, there's a regulation issue. Importing LNG is just ludicrous. So we just need some good policy on getting some of that 2 terajoules of gas into the market. So if we get some common sense policy, which again it looks like there will be, that will help. But then I did see Chris Boland talking about the renewable target by 2030, which seems totally unrealistic and not the right way to go. So anyway, to summarise, the feedback we got from the companies is the government has finally started to listen. We think we will get better policy, not amazing policy, but better policy, and a switch or an easing in the regulation. Because the biggest thing, again, speaking to management through this reporting season, was productivity and regulation and red tape. We need to see a reduction in that. It's ludicrous, some of the stories we've been hearing about, rolling out fibre to housing construction, labour rules, the unions. It's a highly unproductive set of frameworks at the moment. We need some regulation to help productivity. So, the good thing is I think leaders are listening, and we're likely to get better outcomes over the next couple of years.
Thanks, guys. The next question is back to interest rates. How many interest rates do you believe are left in this cutting cycle?
Yeah, I think there's one. Again, using all the data we have in front of us, it looks like there's one more, and then it looks like a large pause. Obviously, our view can change as incoming data comes in globally. I mean, the big driving factor would be the US labour market. So US consumers, sort of like the backbone of the global economy. So if the US consumer really deteriorates, we could get more rate cuts. But as we sit, we think there's one more RBA cut left. We think they pivoted to dovish, and they will have to walk back their dialogue, which was really, we saw that with Michelle Bullock last night. She did a speech and started to walk back the dovishness. So we think one more rate cut and then a long protracted hold.
Thanks for that, Matt. We might go back to some more rapid fire stocks. What are your thoughts on Xero?
Post the D rate, it's probably a buy now. There's an emerging construct, a negative construct around SaaS and how AI is going to impact it. We think that's probably overblown. It's expensive, but we believe that that most recent acquisition will pay some dividends over the next 18 to 24 months. So it's probably a buy at these levels.
Thanks. Macquarie Group.
Macquarie, it's classified as a hold. You probably pull, like the way we look at it, we've pulled down our holding in Macquarie. We've got a small holding. We'll want to increase it over the next few weeks, but then back end of September, October, we'd probably increase the weight if liquidity starts easing. And this company relies upon open capital markets, so that should improve as the back end of the year comes around.
HMC Capital.
Hopefully they don't know where I live. It's a sell.
Judo.
That's one for the small cap team.
Yeah,
Okay.
like from a bank perspective, it looks extremely expensive and short of capital. But again, the small cap universe looks at banks differently.
Great, thank you for that. James has asked, do you own any rare earths companies in the portfolio?
Yeah, we do. We've had a decent holding in Luca over the years, and we pulled it down a fair bit due to some of the end markets being ordinary, and also the Ayoub project being not really viable with the current pricing system or framework. But when the US government kicked in with the Department of Defense floor price, that was a game changer. So for us, this is the event we've been waiting for many, many years for Luca to have a ex-China price, and we do have that now. So it's a game changer. When will you get rewarded for owning it? We don't know, but we think it's a must-own now, given the change in the framework. So we do own it, and we do have some Linus as well. Linus, was an ex-China play for us. When China was using rare earths as a bargaining tool with the US, we positioned to Linus because it would be a beneficiary. But our biggest weight in the rare earth space is Luca. And for the reason we think there'll be a floor price or contracts with a floor price for them to make any other stack up.
Thanks, guys. And a couple questions on your thoughts for Life 360.
A lot of momentum, executing really well. It's had a great run, probably consolidates again here, but we expect it to go further. So it's a buy.
Thanks. The next one is Qantas.
Probably the standout meeting that we had this reporting season. Management there are executing incredibly well. They're generating a lot of cash. They're doing right by the customer again. They're replacing the fleet. We think earnings continue to grow above what market expectations are for the next 2 to 3 years. So it's had an awesome run. One of the hardest things to do is to buy a stock after you've sold it, and we've bought back in. And I can easily see it going to $13 or $14 over the next year. Bye.
Thanks. And we have a couple questions on Telix Pharmaceuticals.
Wish we had Anna here. She could have given us. She met with him yesterday.
It's incredibly tough. I mean, like we said, the market's got no patience for delays or, when the probability of success swings. Telix is very much caught up in that at the moment. So, we're trying to get some more information around the FDA process and, whether it will get approved, through this statement of issues. So, again, we think it's actually looks interesting, but again, it's we don't have much visibility on the FDA process, so it's hard to make a high conviction call on that. But it looks like reasonable value here on the base business anyway. So arguably, you could say you're getting the option for free, but if it did get rejected, and then it'll get hit. So
it's a little bit binary.
Yeah.
But we own it in the portfolio, so we're happy to take a certain level of risk on it.
Thanks, guys. And the next one from Richard is Region Group and Charter Hall.
Region is a sitting on the fence hold. It's around fair value, so we'll kind of park that one. And Charter Hall, it's game time again. Volume and activity and transactions are starting to kick off again in the market, and this is somewhat the default REITs for lots of people, lots of generalists and momentum funds. So it's had a great run and probably keeps going. So bye.
Thanks. And Glenn has asked your thoughts on Nuix.
Haven't followed that for a long time. It's fallen out of the index and very, very small, so we don't follow that one. Sorry.
One for Tobias. Two for Tobias.
Okay, thanks. We'll make sure we ask Tobias. The next one is let's see, from he hasn't put his name. It's on tariffs though. Do you have any thoughts on the tariff shenanigans and what impacts do you think it will have on the WAM Leaders investment portfolio? I'm assuming those are the US tariffs.
Yeah, I mean, the biggest we saw the impact on Liberation Day with the infamous sign that Trump was holding. That's sort of the impact it had on markets short term. It's quite difficult to lay it all out, but when we look at tariffs, effectively, the way we look at it is the US is collecting tax from the consumers. It's running around, I think they'll get around $300 billion over the next 12 months. So that's sort of the run rate of amount of money they're collecting. What that means is it's going to either show up in inflation or show up in margins. And that's the debate everyone's having, where does it show up? It doesn't disappear. It's going to have an impact somewhere. So inflation will go up and consumption probably goes down in the US, so activity. So it's not a great environment, like the tariff environment doesn't make much sense to us. From a fiscal point of view, everyone's happy with it because the US government don't have to issue as many treasuries as they would have had to. So from a fiscal point of view, it's probably okay. And how do we position for that? It's really through working out interest rates, the impact of interest rates off the back of tariffs and from inflation, and then the flow-on effects for Australian companies which are operating in the US and importing a lot of their raw materials or unfinished goods into the US. So we have to work out from a company-by-company impact, will it hit their margins? I mean, that's a big debate. And I mean, it's quite mathematical. Let's call it $300 billion. Where does it show up? Either the companies eat the margin or it goes into inflation. So we're just waiting for evidence on that. At the moment, it looks like it's companies wearing the input costs at this point in time. But eventually that will change, and inflation is ticking up as well now. So, it's a yet to be determined, but, we are watching it carefully, and it's really shaping our interest rate view and how we position based off that.
Thanks, Matt. And sticking with the US theme, Ian has asked, given the US government inability to cut spending significantly, how high can the gold price go if the US continues to print more money and push debt levels higher?
Yeah, they've actually been withdrawing money from the quantitative tightening program. It's really like the gold price is effectively a bet on the fiat system. Do you think the US dollar is getting devalued, and it has been devalued by you've seen the US dollar fall? So it's really around your framework. If you think the US, exceptionalism is over, gold price goes much higher. If you believe in US will rein it in and not issue bucket loads of treasuries and finance this through back channels, then you probably think gold falls. So it's really just a bet on your view of the US fiat system or the global fiat system. At this point in time, we don't think US exceptionalism is over. And we think the current situation is they have reined in a little bit of spending. The Doge program was a bit of a farce, but the tariffs, if tariffs are in place, it actually does help a lot. But there is that impact we talked about between inflation, which inflation is good for gold anyway, but it could be a margin crunch and lower rates, which arguably is good for gold anyway. So, yeah, most roads point to good for gold, but there is a few scenarios where it's not good for gold. If fiscally things get better and you get some high growth rates, people will move money out of gold into risk assets again.
Thanks, Matt. And a question from George. Do you think the relatively high volatility in blue chip share prices during this year's earnings season is driven by investors only interested in short-term outlook and performance, or is it due to increased algorithmic automated trading?
Yes, yes, and yes. Yes, and yes.
And I'd also add the fund management industry not willing to take risk.
Yeah.
There's a huge lack of appetite to take risk, and there's a huge crowding mentality at the moment because I think everyone had pretty poor years, and any tracking error they quickly cover. So we're seeing it like when CSL fell, like BHP, CBA got bid straight away because people like covering risk, and so it's very, very tight, crowded market, and a whole lot of influences at the moment.
And just on, I think one thing that we need to accept and acknowledge going forward is one thing that AI does is, when a stock falls 10 to 17% or whatever it might be in the day, that always happened in the past, but it would take 2 to 3 weeks to get there. It's just happening quicker now. So you just need to expect that share price reactions, deratings, whatever it may be, just happen instantly, effectively. So we need to be more prepared and more nimble than previously. And we certainly have a lot more short-term money chasing the market. There's a lot more hedge funds who get remunerated on a day-to-day basis. So, they don't look beyond the next quarter, forget what the next year's going to do. They're just worried about what's coming up.
Well, yeah, I mean, some of those guys, if they have a bad month, they get fired. Like very, very short term, or they get capital withdrawn from them. So it's, really been obvious to us. It's probably been happening for about 18 months, to be honest.
And we've had to adjust accordingly.
Yep.
Thanks, guys. The next one is from Anthony. He says, the recent improvement in the WAM Leaders share price is welcome. Are you expecting the NTA to also increase?
Well, the NTA's been increasing at a quite good trajectory. I mean, I think we put out the NTA today, which was $1.38. So we had a really good month. Momentum has continued. So, we're really happy with how the market dynamics are working, and we have adjusted the way we're investing to reflect a lot of these thematics going on at the moment, which was a great question before about the moves in the reporting season and the quantum of the moves. That really demonstrates how we have to change how we've changed the way we're investing because we have to play by the rules in front of you. So, and that's what we've got at the moment. So for us, we've got great momentum. We want to keep outperforming, and go back to those days where we do 10% outperformance. I mean, that'd be ideal. And, within the first 2 months, we're already, well on the way there. So for us, we just see a clear runway ahead. And the portfolio, we think, is in great shape with a lot of embedded value still left on the table within a lot of the names. So we don't feel like the portfolio has just had a great run and is exhausted. We still think there's a huge amount of potential there. And there's also a huge amount of overvaluation in the market too. which we touched on, CBA, Wesfarmers. I mean, JB Hi-Fi arguably is overvalued too, but there's quite a few that still could derate dramatically. We have very low positions in a lot of those, and some not at all. So for us, the mix, the dynamics are very welcome. We do have a clear roadmap over the next quarter, and we think the market is moving toward our direction around the tighter liquidity, the global bond market, shaking around a bit and selling off. We think that will hurt those overvalued sectors. So for us, that's a great opportunity. But then equally, when the liquidity or the bond market settles down, we've got to move back to the way the market was moving before, and we will do that now. We will be more responsive to how market moves in the short term. So for us, it's great to start the year, really, really big tailwind. But we think it's just a start, and really excited about the rest of the year.
Thanks for that, guys. And we will end on our last stock picks. So the next one is Spark New Zealand. What do you think of Spark now?
Yeah, I mean, we talked about being too early. I mean, Spark was a classic case of being too early. We could see the opportunity there. Like, what do we think of it now? They have done the cost out, the heavy lifting. So Spark reminds us of Telstra when Telstra saw their enterprise division fall apart, basically. New Zealand government stopped spending. So for Spark, the New Zealand government were a huge client. They've been in a bad recession for a couple of years. So the New Zealand government don't have spare money. They've been pulling projects. So is it Spark's fault? Probably not. But could they respond faster? Probably they could have. But what they've done now is respond. So we've seen the share price rise from $1.80 to $2.30. We've got to $2.40 at a point. So we think they've turned the corner. It's gone through the worst. It's actually a higher returning business than Telstra. So it's investment grade. They've sold down their data center business, which was a real concern for the market because they thought they would come a lot of capital expenditure. That's off the table now. Now can focus back to on a high cash generative company, high dividend payer, and go back to boring. Boring is good sometimes, and these companies should be boring. They should be growing at GDP plus a few percent on price. So it will return to that, and the earnings hole has gone now. So for us, Spark, we were way too early. It had some pain, but it's actually recovered strongly, and it's been a decent contributor. Probably in the last 3-4 months, it's really picked up. So it's actually got a lot of tailwinds for us on that company now.
Thanks, Matt. The next one is EBOS Group.
Yeah, just trying to think. It's not one that we hold in the portfolio, and we haven't looked too closely, but I think the result was a bit weaker than market expected. It's lost a few significant contracts. Probably not one for us that we're going to look at anytime soon. So I'll just sit on the fence and say it's a hold, but it's not one that we're too close to.
No, we don't have a really strong view on that one, unfortunately.
Thanks, guys, for the transparency there. Stockland.
We had a great meeting with Stockland. I mean, had a great result, ran really hard. The thing I'd highlight there is Victoria. We don't want to call the bottom in Victoria, but it's probably the worst is over for Victoria. It's actually seen some volume increase in sales and also price. So Stockland have a big exposure there. Probably what we underestimated with Stockland was the optionality on their book as well. They got a huge property book, land bank, and they have great exposure. Like Tarun, the CEO's come in and given it a new access to capital framework. So that's been really positive. So for us, Stockland reported well, has momentum, might face a little bit of a headwind with maybe interest rate cuts coming out of the curve. But for us, that will be an entry opportunity because we think the fundamental business is great and has a lot of optionality. So, Stockland looked very good for us as one of the highlights. And, I mean, the REIT sector actually reported really well, like Centre Group, GPT, Stockland, CHC, Charter Hall. I mean, Goodman was an underwhelming one, but, again, we think that's temporary. But the whole sector did well. Yeah.
Thanks. The next one is Challenger.
Yeah, I mean, Challenger's been a core holding for us for a couple of years now. And finally, we saw the re-rate we were waiting for. So it was trading $5-6 for a period, and then you've had the Japanese come in with their strategic stake. The biggest thing for Challenger has been the potential change in the capital framework from APRA. So essentially what's happening there is Challenger can change the mix on the way they fund their asset and liability. So instead of holding illiquid assets, they can actually hold high-quality liquid assets, which will be a bit of a game changer for Challenger. And people are just starting to see the potential there, what this will mean for Challenger. Capital management, it's in a great area. Like, they've got a lot of structural and demographic tailwinds. It's in the, that pension phase type annuity. It's actually looking really attractive. When it got to high $8, we thought it looked expensive and did sell some. But the low 8s, it looks really attractive. And again, I think it was about 4 results in a row where they've pretty well beaten expectations. So it does have momentum, even though they've been doing a lot of work on the background through costs and changing the mix of the book. Despite this, they've actually been beating expectations. So Challenger looks good and has a good future ahead of it.
Thanks, guys. The next one is MA Financial.
That's one for the small cap team.
Don't follow it.
Yeah, not close to that one.
And Orica.
Hitting its stripes, doing really well. It's consolidating up at these $21 level. Probably has another leg of share price growth. It's a buy.
Thanks, guys. And the very last one, WAM Leaders. Is it a buy, hold, or sell?
Did we do the disclaimer at the start of the call?
We did.
We'll do our best to channel Jeff here. We like to buy things at a discount to their asset value, and I think Leaders is a small discount. So with the no advice hat on, it's a buy.
Yeah, I mean, like, the NTA was $1.38, and I think it was trading $1.33. So by that, Jeff's definition, it would be a buy, wouldn't it?
I think it would. Thanks very much for that, guys. Thanks to everybody for your questions. Matt, I'll hand over to you for some closing words.
Thanks, Olivia. And just like to thank everyone for joining us today as well. Really appreciate the questions coming in, and very well informed, and love the angle around cheap stocks. It's something we always look for, like when companies get beaten up, whether there is an opportunity. I just like to warn that strategy is fraught with danger at this point in time, because of I'd say the market is scared of taking risk at the moment. So you won't get rewarded quickly for those beaten up stocks. But yeah, just like to thank everyone for joining us. We did have a tough year last year and a tough year before, but we've hit the ground running this year. We're like really confident on the outlook, really confident on the portfolio, and look forward to getting back towards some really strong results and sharing them. And look forward to the next webinar where we can answer all these questions. So thank you.